Have you ever considered how central banks, like the Federal Reserve in the United States, exert their influence on the vast flow of money within our economy? Open market operations are the primary tool central banks use to influence the money supply, directly changing the amount of reserves commercial banks hold. When the central bank buys government securities from banks, it injects new money into the banking system, thereby increasing the money supply. Conversely, when it sells government securities to banks, it withdraws money from the system, thus decreasing the money supply. This powerful effect stems from the core principle of fractional reserve banking and the relationship between reserves and lending. When the central bank purchases securities, it pays by crediting the selling bank's reserve account. These increased reserves allow banks to make more loans, as they now have excess reserves above their required amount. Each new loan creates a deposit, which then enables further lending through the money multiplier process, amplifying the initial injection. The opposite occurs when the central bank sells securities, as banks lose reserves, reducing their capacity to lend and contracting the money supply. Central banks conduct these operations by engaging with primary dealers, which are a select group of financial institutions authorized to trade directly with the central bank. These transactions are typically with short-term government securities, often referred to as treasury bills. For example, if the central bank wants to expand the money supply, it will purchase treasury bills from these primary dealers, crediting their accounts held at the central bank. This instantly increases the banking system's reserves, setting off a chain reaction of increased lending and money creation throughout the economy. This constant buying and selling of government bonds by a central bank like the Federal Reserve is not just about moving money around. It is also the primary mechanism through which the central bank influences the federal funds rate. This is the overnight interest rate at which banks lend reserves to each other. By adjusting the supply of reserves through open market operations, the central bank can steer this crucial benchmark rate, which then trickles down to affect other interest rates throughout the economy, from mortgage rates to business loans. Understanding open market operations reveals the sophisticated precision with which central banks manage economic conditions. By strategically buying or selling government securities, they fine-tune the banking system's reserves, directly impacting banks' lending capacity and influencing interest rates, ultimately guiding the overall availability and cost of money to foster stable economic growth.